everyone. I'm Rick Bensenor. Today is Tuesday, October 11th, and welcome to this week's In the Know Trader Show. In our trader education portion, we're going to do part 2 of what we started last week, knowing when not to press your bets. And then, because we've got so many key financial stocks reporting this week, and starting on Thursday, but mostly on Friday, I figured let's take a look at the 10 biggest financial stocks out there as far as capitalization. So we'll go through the XLF. We'll look at it on its own against the S&P for relative performance, and then we'll take a look at these 10 stocks. To sign up for my weekly Tactical Trader Report, which comes out Thursday nights most week, go to inthenowtrader.com. This is a report that gives a very broad-based macro background on what's going on with key levels for the bond market, for stocks, usually for the dollar, some commodities. So you get the key sectors here, or maybe better said, asset classes. And then I give you a new ETF trading idea each week and follow up on every open position we have until we close it out. That is the weekly Tactical Trader Report. We also have a monthly Spider Sector ETF report. The goal here is to beat the return of the S&P 500. And we do that, or at least we aim to do that, by being in no more than 7 of the 11 Spider macro ETFs like XLE, XLK, XLY, etc. There are 11 sectors to the market. We pick no more than 7 to be in with the goal of beating the market by staying out of the underperformers. And so far, year to date through September 30th, we are outperforming the S&P by 408 basis points by being able to combine our quant model and my technical views to come up with a proper rating system and allocation for each one of those 11 sectors. And then I picked the 7 that I think will do the best. So we have outperformed in 8 of 9 months this year for a total of over 4%. Since we launched this product in August of 2020, which is 26 months ago, we have outperformed by 8.88%. If you know anything about the money management industry, you know that very few people consistently outperform the market. We outperformed in the up move through 2020 and 2021. And have outperformed by over 4% this year in the down move. So it's not like, oh, I outperformed because I figured out we were in a bull market. I also outperformed because I figured out we were in a bear market and appropriately changed which sectors we had allocations to. The way we have these numbers here would put us in the top 10% of all money managers out there. So this report comes out on the last day of each month. So you get new allocations for the next month, and the price of this is no more than $87 a month, and can be well lower if you subscribe to both products as well as do that on an annual basis. You get this down to, if I remember, something in the $60 a month neighborhood. So very inexpensive way to be able to consistently outperform the market. So if you've got money in Spiders, if you're a financial advisor and you have clients in passive investments tied to the index funds, we're doing far, far better than they are. And if you're an individual trader and you buy the broad market, as many do, as part of their portfolio, besides just owning individual names, this has proven over its lifetime to chip away month after month and give you a far better performance than if you were in the Spiders themselves. So if you're watching this, you're probably watching this on my YouTube channel. If you're new, you can subscribe to the channel. That's youtube.com/InTheKnowTrader. Click on the subscribe button. And then anytime you open up the YouTube app, the most recent videos will be right there in front of you. I also occasionally tweet on Twitter, so my handle is @InTheKnowTrader. So please follow us too. All right, let's take a look at part 2 of when knowing not to press your bets. So last week we talked about that there are times in the market, and we were showing those a week ago, where you could certainly get a bounce, and that if you were going to be a seller, you had an opportunity to sell well into the bounce instead of starting off last week as being a seller. The point being, sell into rallies in a down market. And why I want to, I didn't come up with a new topic for this week, but I wanted to expand upon what I talked about last week, is because, and I don't often on this platform talk to you about the S&P. My views on the market are saved for subscribers to In the Know Trader. So I don't normally talk about it, but I will use the S&P chart simply as a way to show you that in a risk-reward point of view, we're getting closer to where we'd expect to find support. And to think about this in terms of when you position and the location of where you make your trades. So think of this just kind of right now, this week, there are 42 of the S&P 500, so a little less than 10%, are on setup weekly 9 counts. And we know that setup weekly 9 counts often can be a potential near-term turning point. Doesn't have to be, but it certainly can be. Next week, we will have hundreds more, because right now we have hundreds on setup 8 counts, meaning that if both this week and next Friday, this Friday and next Friday, have closes that are less than the close from each one of them, respectively, 4 weeks prior, we'll then have the 9th week in a row that the S&P has sold off with that particular pattern. And during the entire decline that we have not done that yet in the entire year. So this week happens to be an 8 count, which from a timing perspective suggests that over the next couple weeks, we have a better chance of finding some type of trading bottom that could be a decent one. So keep in mind that as you see the progression of this decline this year, sell-off, rally, we're in a sell-off. We're probably going, I've got a target down in and around 34.50, probably 15 points either side, 20 points either side of that is my next kind of real important level. And today the market has done a reversal. The S&P at one point was down about 40 points. And now, as I record late morning, we're actually up about, what are we up? We are up 9 points now. So we have gone in the green after being and making a new low, in fact, a new 2022 low. So again, your fine buyers come in, and you want to, if you still think there's more to go, and I do, but being a seller here at, let's just say 36.20 is a very different call you're making than having sold virtually any other time this year. So the closer we start getting towards a target at 34.50 and bigger targets down beneath 3,300, the more you realize that having not sold earlier this year changes the equation very much of first pressing the bets now that we're going lower. And given the multitude of stocks that are going to be on -9 counts next week, as well as the S&P itself being on a -9 count, just tells you that in the scheme of things, it's harder selling down here, obviously, than having sold other times this year. So I want you to think about also that it's something to, an expression I heard a long time ago in this business, and it's very relevant, is sell when you can, not when you have to. Right? When you have to sell, it's because the pain, either financial or emotional, is too strong for you that you simply go, get me out. I don't care what price, just get me out. Now, we haven't seen a flush out like that, but I suspect it's coming. Now, whether it comes in the next week or two or sometime over the next several months, I'm not sure, but I suspect it's coming. So you'll still get some type of even higher move in the VIX than we're currently seeing. So let me see, right now I've got the VIX at 32.5. It got as high as about 33.5 today, but it wouldn't surprise me if we get to the upper 30s or 40s on a real kind of get me out at any price type of feeling that certainly can come. So I want you to think about, and of course, if you're not a subscriber, you wouldn't know that 2 weeks ago, I said when we made the low for the year until today, I said that a rebound would not likely get past 38.19. And last week's bounce was, here, I'll kind of blow this up a bit so you can see. But last week's got to 38.07. And I said we would not get above 38.19. So even in the rally last week, I gave you, if you were a subscriber, you would have had much better idea where to lean into the rally than having started off the week leaning into the rally and having sold just before the S&P added a couple hundred points. So understand in the context of when you make your buy and sell decisions, where you are in terms of risk versus reward for that. So I can make the case that we're still going sub 3,300. Again, it doesn't necessarily have to be this year, but before we find the true low to the entire down move, that we could get to the low 3,000s in the S&P. All right, so we're still talking more than 10% away from where we are now. Now, this target comes from measuring kind of Elliott wave type targets. And just to show you, this was on the upside, this was a wave 5 target back in 2018. And it basically very much was the right place to have sold. In 2020, just before COVID hit, there was an upside target that had been in place since 2016 that basically caught the all-time highs before COVID hit. And you can't anticipate something like COVID coming, but you can figure out where to be a seller in what was a bullish market. In other words, again, sell when you can, not when you're forced to sell. So even now, when I look at some possible downside targets that I have, which is in and around 34.50, and I suspect that can still trade this month, and then down beneath 3,200 even, there are better times to think about where to buy within this down move. and to sell using rallies rather than sell because you're puking out of a bad position that you've held on to endlessly, rather than taking advantage of the rallies that sometimes come. So we'll see how the market reacts off of the mid 3400s, and if we get a rally. I would still say at this point that I wouldn't, let me see, 3450. Well, actually, I'm not even going to tell you how high I think it could go from there. But I know I'm going to start doing, some very light buying here just because it could hold, but more substantial buying under 3200. In fact, there's a multiple, I think you want to, at some point, decide to start scaling back into the market. And we're not there yet. But it's really important to know when not to be pressing bets in the direction of a trend, and when you want to lay off, to let the counter trend people, in this case, those who are bulls, come back in, push the market up to give you a better chance, especially from a risk reward point of view, of selling. So those are, that's really what I wanted to expand upon from last week, and help you put risk and reward into perspective such that you don't buy in an uptrend at a time where, in theory, smart money is likely selling, because you're going to have a drawdown probably fairly soon, right after you make that decision. And given this type downside targets we have now, essentially down to the low 3000s, you want to make sure that if you're still selling stocks now, and again, if you had listened to us virtually the entire year, we've been sellers, other than a couple weeks after the June low, we got tactically bullish and told you that we're not, that anything north of 3270 is where you want to be a seller. And of course, we got to not 3270, 4270, and anything north of that, you want to be a seller. And we got to 43 and a quarter in August, and then quickly, that's the peak up here, and then quickly fallen since. Pick your places to buy and sell based upon risk versus reward, where you are in the cycle. And if you find yourself getting caught into, oh my God, I have to sell now, I'm going to lose it all, it simply means that you are unwilling to sell when you had a chance to sell, and now you're feeling forced to sell. And that's not a comfortable position to be in for anyone. And it's almost always a losing type proposition if you look, a month down the line and 3 months down the line, when you're into that forced liquidation that you self-impose. It's usually not the right thing to do, and savvy market players look for those type moves in order to help find true bottoms. The same way back in 2020, we turned bullish, we meaning myself. I'm so used to still saying we as if I'm on the sell side representing, Morgan Stanley or any one of the firms I work for. It was very well known at the time. I turned bullish March 23rd, the day that made the low to the entire COVID move. We got long, and then we bought the April 1st, 1 week later. So we had rallied significantly off of the low, and then we bought the pullback too on April 1st, and held that for quite some time. Not as much as it was worth, because we lightened up before. We caught a good amount of this, but we didn't capture it all. But we weren't short, and we were still tactically going long. But this is where we made the big decision to go long. Anyway, I hope that helps a little bit as you navigate the markets and think about how and when you make your trading decisions, if you're doing them based upon need or want. So that's my thoughts for that. Let's take a look at the financial sector. And before we even do that, reminder, and I'm so glad I remembered to go to this slide. On October 31st, I am speaking at the Money Show in Orlando, Florida. It's going to be the last time that I do a no-cost presentation on how to use cloud charts. In the Western world, I am known as the foremost expert on that technical indicator. There's a lot of information out there on them. What I will tell you is 50% of it is incorrect. I will be discussing and teaching how to use cloud charts at the Money Show. It will be the last time I do that on a no-cost basis. In the future, I will be coming out with a webinar on how to do this for a cost. So this is the last chance that you have to understand how to use one of the most key indicators that I use in my repertoire. For anybody who follows the work I do, you know we're always looking at this model. I will walk you through how to use it, the reasons the numbers are what they are, how they came about, and most importantly, the strategies for using this. So again, this is the last time I'm going to do this. And if you're interested in going and plan a trip to Florida, or if you're in that kind of central Florida location, here is a link that you can use. So it's here in front of you to register for the Money Show at a discount price than the standard fee to go into the whole show. There are probably 50 different speakers at the show. So I have a particular time slot on that Monday where I'll be doing this. But so there's the Money Show is probably the most famous retail-oriented investment show and trading show there is. And there's the two biggest ones are the Orlando one that they do, and they also do in Las Vegas. Now they do other ones across the country, but those two are the biggest ones they do each year. So you have a chance to meet. If you go to themoneyshow.com, you'll see all the different speakers who are there. But I'll be speaking on Monday morning, and here's again a discount link. So let's take a look at the top holdings in XLF. First of all, it's virtually 99% financials and a touch you'll see in consumer services and industrials. Here are the 10 names that we'll go through. Obviously, there are more names in the XLF, but these are the top 10 based on market cap. And so these are the ones we'll take a look at today. Let's start off with, let's go to charts. And let's start off with the XLF itself. And let's put up the cloud chart. Let's put up sequential. Let's put up TDST lines. Let's put up propulsion. Let's put up a MACD. All right, so here's my basic view on the chart. So you'll notice that there's been some support earlier this year on the spring lows. We stopped where we did when the lagging line from the cloud was against the bottom of the cloud. We rallied back up to not only stall against the baseline, but also where the lagging line hit the top of its cloud. So we went from bottom to top, and now we've come out the bottom. That's not a good thing. Last week was an up close. This week, so far, it's only Tuesday, but looks like it'll be a down close relative to last week. We don't know for sure yet. It's too early in the week. But that gives you a qualified breakdown of this TDST level, the dotted line, which is at 30.89. And that minimally suggests that we're going to go to a 9 count and possibly even further. So where we close this week and how we trade next week, because next week can confirm this week's move, still would suggest a down move coming here. And the fact that we've come through the bottom of the cloud is not a good thing. The S&P did this several weeks ago. Financials now did it a few weeks back. And at the very least, I'd still expect this to be heavy over the short term. Let's look at it versus the market itself and what we have here. Hold on, let me take the cloud away for a second so I can draw my lines. And hold on, XLF versus SPY. I knew that didn't look right. There we go. So let's take a look here. Let's draw this line and notice that, hold on, that's a channel. I don't want a channel. I just want a straight line. Okay, let's do this again. Here we go. And it's still giving me a channel. So what the heck, we'll just lay it on top there. Notice that what used to be old highs that we broke out of has now been 3 times the lows. So this is financials versus the S&P. It didn't get the 13 on the downside. It got to a 12, and it would need to pull back again pretty much to test this line to get that 13. But we have been outperforming since the summer. Has not been able to get above the bullish propulsion level, which we'd like to see in order to think that we go back to the top of the range. And so we've got, a double top and a triple bottom right now. MACD, just kind of crosses near the zero line. So it's telling you you're in a flat type of trading range, and you certainly are. But we slightly favor financials. This week is going to be obviously a very big determination, at least how it starts off, with all the names that report Friday. And there's a significant amount of key S&P bank-related names that report this week. So by the end of the week, we'll have a pretty good sense of if there's going to be follow through to the upside as far as outperformance, or we pull back down again towards this line of support. But in general, I think the line is kind of in the sand here of the approximate range that financials need to hold versus the S&P to still have a chance to move up over time. All right, let's look at the individual charts. So we'll start with Berkshire Hathaway, the largest capitalization weighted name. And as we're going to see in many of these, they're on weekly 8s, just like the S&P is. So we know there's potential support just beneath the current lows of the year, 259 or so, depending upon if this drops quickly or kind of stays in here. And look, with earnings this week, we'll kind of get a sense. We're going to also want to look going out a few weeks if the lagging line can hold above that 258 level also, because if that then breaks, then you open the door for this to be a bigger decline. And if you just look at even something like equal legs, so if we were to take the all-time high, measure down to the low, that was the summer low, and then take that same distance off of the high, you'll see that this measures to about 209.75. And that's potentially, if the bottom falls out of this, that's where this would go from the current 268. Now, I'm not saying that's where Berkshire's going, but we need to pay attention over the next few weeks. Do we get a bounce on the 9 count? If not, if we get a plunk from earnings, then we'll probably finish out a 13 count. Now, the 13 count also doesn't have to necessarily get this low, but it would then give me a clue that I probably don't want to be a buyer until then. So that's the way Berkshire looks. Let's move on to JP Morgan. Not a good looking chart either. This has broken beneath a long time ago and is getting closer to, unfortunately, these are COVID lows back in here. So right now you're on an A count. There is important support at 95 1/4. And that, if we get down there next week, so if JP loses, let's say 8% or so over the next week in a bad quarterly report, you can at least make the case that on a 9 count, you could buy against this 95.25 level and at least have a sense, you're at least buying towards the low end of the COVID bottom. And it's no guarantees it needs to hold. And let's go back in time and just see. So back in 2017, and I'm going to take the cloud off because right now I don't need it, but we see the pullback in 2017 is pretty much the COVID lows. So if these levels in 95.25 don't hold, then you have a really important support down here. And I think we'd be in real bad shape if you saw these lows get taken out. But same thing, the next couple of weeks, including earnings this week, are going to be really important. Bank of America. Interestingly, on not only a 7 count this week, but a 12 count, and they report earnings this week too. So next week could be an 8 and a 13. The week after would be a 9 and a 13 from the week before. And you have an unfilled gap down in this level. So from here to down here, so either side of 25, you have support. So this is going to be interesting. This kind of makes me think that we're not done on the downside and that there's a decent chance that until we kind of get down in there, this is not going to necessarily bottom. But it's not, this is where one of those cases where you don't want to be selling now. Simply, and it doesn't mean that from 29 to 25 on a percentage basis is still 16% down, but heck, you had all this time to be a seller. If you wait for now, you're more in that camp of, gee, I'm forcing myself to sell. So I'm looking for some major support in the mid-20s. Wells Fargo. So hasn't had the lagging line break beneath its cloud. It's still above this year's low. So this is technically a stronger name. However, last week was an up close, which means if this week closes beneath 40.37 and next week opens lower, takes out this week's low and closes lower in the week, that would then suggest that you'll still likely trade lower down to the low 30s from the current 40 level. You've got to get above 46.5 to break this out on the upside. So same type thing from here, you're kind of mid-range of what you want to do, but again, better than the other names we've looked at so far. S&P Global, not a bank, a services firm too. S&P puts out all their different indexes and research on an 8 and 12. Good to know that because that means next week is likely a 9 and 13, getting close to a bottom, or at least in a place that it's what I would designate generally as too late to sell. But it has broken beneath its cloud. It failed against its bullish propulsion level, has now faded, and it's not a good looking chart per se, but from a timing perspective, it may be closer to some type of tradable bottom, which at least then gives you a chance to sell up into resistance instead of selling down here. And that is kind of the point of what I'm trying to talk about with some frequency. Morgan Stanley, very important week. The more Friday closes we get beneath 76.25, the lower it potentially goes, because again, you've changed kind of the look of this from what has been bullish for the last 2 years into a more bearish looking chart with clear overhead resistance. So you're going to, here it's going to be tough, because if you break down, this would suggest we're going lower, But in the next few weeks and 3 weeks from now, you might get a 9 count that stops us. But any one of these areas down here, that any one of these levels or potential targets, 73.5-ish, 68.75, 67-ish. Those are all potential downside targets that are active. And on the upside, well, resistance against the bottom of the cloud and the top of the cloud. So, and in here is where it's just tough, and there's not a heck of a lot you can figure out what to do. Again, why I'm always inclined to sell when I can, not when I have to. Goldman Sachs had one weekly close beneath where the lagging line broke, came right back, failed against its bullish propulsion level, came back down, has broken. Earnings coming out this week, still a negative bias here. Minimum downside target is 284 and change. Other targets are 259, 246, and then way down near 210. Charles Schwab, one of the stronger names, lagging line above its cloud, well off its lows from the summer, but it also hasn't been able to get above 76 and a half or so. 76, where is that? 76.41. All right, so we've stalled there for a couple months. If we break, you get the more Friday closes you get under 68, the worse this would be. But one of the better names we've looked at. And then the last, we have two left. Citibank, almost always a disappointment. Citigroup, almost always a disappointment for holders. The cloud chart is actually not helpful at all here. I'm going to switch this to a monthly view. And see if there's anything I can decipher from it. So support down here from 2016, 2020, that's near 35 or so. It's trading 41. This has been back and forth for years, and really disappointing stock over time. I've had this forever. And I think I actually got in back in 2011 on this 13.9, and I took a little off, but considering how high and how far off, if you take a look at all-time highs and where this has been, let's say in 2007, and you see that this was a $550 stock trading at less than 10% for a major global bank. It's just consistently a huge disappointment. And last is BlackRock, which, hold on a sec, got some disappointing news today. With some pension funds or state funds pulling out of their ESG investing. I'd seen somebody on CNBC earlier today talking about that, and David Faber was saying whether or not it was going to lead to other places doing the same. So BlackRock under pressure, and I'm pretty sure earnings are out this week too on them. Not 100% sure, but I feel like they're out on Friday also. Or maybe even Thursday. I know one of the big banks comes out Thursday, but the rest of the big ones come out Friday. So you have a 13 here that is now playing with its risk level. If you get a few Friday closes beneath this, you're going to do a 9 count, but it's not a 9 count. I'd be terribly would put a lot of merit into. There's a TDST line here that's also broken. So not a particularly good looking chart, honestly. And at a minimum, I'd have to see a Friday close above the close from 4 Fridays prior to even have any sense of maybe doing a little nibbling, but not a pretty looking chart. So that's it for this week. We concluded the discussion I wanted to have about not necessarily pressing bets when you're deep into a decline or pressing bets deep into a rally. There are times and places that will serve you better to make important decisions than, selling after a market is off 25%. And it doesn't mean it can't go lower, and it doesn't mean selling is necessarily the wrong thing to do for a particular name. But in general, you want to take advantage of the bounces that you've seen and lean into those instead of selling on a day, that the market's off 100 S&P handles. All right, that's it. I'll be back next week. Thanks for having been with us this week. Bye-bye.